Welcome back. Earlier today, it was reported US GDP slowed to a rate of 1.1%. That was below the consensus expectations of 1.9% and well below the prior report of 2.6%. We're going to look at several components of GDP. Again, of course, GDP is the measure of all goods and services produced in the U.S. We're going to look at GDP per capita, that's per person. The household GDP, which is very simply the amount of debt incurred by each resident household in the U.S. economy as a percentage of the overall GDP number. And then we have a recession-based indicator index. First off, here's GDP shown in red. Purple line represents S&P 500. We can see there's a very strong correlation, at least until the top, which was achieved early 2022. That's when inflation really took hold of the economy. And this is the concern, is that historically when GDP goes up, the stock market goes up. Well, the stock market has not been going up over the past year and change. Again, very large in part due to inflation. If GDP starts to slow, which it kind of looks like it is, how much weight will that put on the stock market and the overall U.S. economy? That is really the concern. And by the way, tomorrow we have the PCE, the Personal Consumption Expenditure, which is a very commonly watched gauge of inflation. That's expected to rise. So if we see really a 1-2 punch here, first, a slowdown in growth, and second of all, an increase in inflation, that certainly is a great cause of concern. Here we see the blue with the red outline, real GDP per capita. Again, that's per person. And then we have the S&P 500. That has really begun to slow. We see a top that has been achieved over here. It's failed to really make higher highs. Household debt to GDP. Now, it is over the long term trending lower. However, it looks like this downturn or this trend to the downside in terms of the household debt to GDP, that has slowed. And I think that could maybe turn if the trend does continue. And then, of course, we have the GDP in red, federal funds rate, a massive increase in interest rates starting at the end of 21, early 2022. And that is really the cause of concern. If the Federal Reserve sees increased inflation, on top of that, a soft GDP number today, and other economic numbers we've seen lately really have not been so hot, that is a cause for great concern because the Federal Reserve may be more likely maybe to raise interest rates or at least not to cut interest rates anytime soon. And then, of course, we have the GDP-based recession indicator index in purple. And when that crosses above the 67% level, that's the signal for a recession. And then once the recession's in place, if it crosses back below 33%, that's a sign the recession is over. The last time we saw this type of signal was 2020, of course. It hasn't ticked up yet, and it's not a fast-moving indicator. But we're going to continue to watch it because if this indicator starts to tick to the upside, that certainly could be cause for great concern. And once again, just the other day we had the durable goods orders, which is a measure of the purchase of large appliances, automobiles, things of that nature, items that are meant to last more than 3 years. That really was very soft except for one large order. I think it was from Boeing. But aside from that, the durable goods orders are also starting to weaken. Now, going to the bond market, these are U.S. current U.S. Treasuries. The 1 month at a 4.27. It was much higher up, around the 5% level. Not anymore, though. We have the 2% at 5.13. The 4 month at the highest yield of 5.21. Much higher than the 10-year bond at a 3.53. The inverted bond market is still very much in place and actually is really extended at this point. This shows us a 1 month percentage change in treasuries. This is how much the yields have changed over the past 30 days. 1 month bond, the bill actually, down 10% in yield in 1 month. That is a precipitous drop. And that is certainly a cause for concern. We've discussed this in other videos regarding the inverted bond market, when we've seen an inversion and then the 1 month drops very quickly, that really is not a very good sign. This shows us the overall month in bonds. Now, in particular, the black dotted line, that's our 1 month T-bill, was very high. Well, yeah, actually very high. Early April, around the 4.7% level, all of a sudden dropped down to the 3.36. Now it has recovered. Now we have to try to understand what the bond market's trying to tell us. The short-term bonds, or the bills in this case, the 1 month, for example, when it dropped in part because the bond market, meaning the investors, the overall economy, was expecting that the Federal Reserve is more likely to not raise interest rates, or at least it was closer to the end. That's what the short-term bonds do. They forecast what's most likely to happen in the near-term future. Conversely, the red line, which is the 10-year bond, tells us what the Federal Reserve is more likely to do and where interest rates are more likely to be long-term. So the red line at the bottom, the 10 years, telling us we see long-term, long-term into the distant future, we see lower rates, which is, by the way, we'd like that, if we want to buy a house or something, but it's not a good sign. If we see lower rates in the future, it means the bond market's forecasting weakness, weak economic conditions in the future. That's not good. Now, the black line, the black dotted line, is a 1 month bond. That was very high because it was forecasting, hey, inflation's up and at least the economy is strong enough now to support those higher interest rates. Well, all of a sudden the black dotted line dropped, which tells us maybe the Federal Reserve is closer to the end of the interest rate tightening cycle. Well, I don't know exactly. It's very hard to attribute a reason why. But all of a sudden, the past couple of days, a 1 month bond, the bill, I should say, is off to the races again. Maybe it's anticipating a strong PCE number, a strong inflationary number. So this chart is really kind of reflecting the worst of both worlds, meaning long term, we know this from the 10-year bond, we see weakness in the distant future. Short term, the one month T-bill is telling us maybe in the near term, more inflation. Here's the 10-year in black, and the red line is the 1 year. The 1 year is above the black line, and that tells us we have an inverted bond market. The blue area chart here is negative, and that shows us to the degree of the inversion, how much the red line, the 1 year, is above the 10-year. Notice where we are here. We have over a 1.2% or 120 basis point inversion. This is the lowest low we've seen pretty much since the beginning of the inverted bond market condition. And again, what this is telling us is the 10-year shows us into the distant future, things don't look so good. In the near term, the Federal Reserve is still on its campaign to raise interest rates. Now, of course, we have here a little bit more information. The 1 year's in red, the 10 years in purple, the white histogram bars in the background, that represents the S&P 500, still chugging along at a very high rate. Well, in a trading range, I should say. The black line is the 1 month. So remember that the red line, the 1 year, usually follows the 1 month. We see the 1 month comes down and then the 1 year follows. The 1 month goes up, then the 1 year follows. Does this spike down? Does that indicate that the 1 year is going to go down? Well, it didn't go down long enough in order for the 1 year to start to go down, and now it's back to the upside. And if history's any judge, if the 1 month T-bill continues to rally, maybe that's a signal that the 1 year is going to rally also. I mean, after all, we're already seeing this, a massive inversion where the red line, the 1 year, looks like it's ticking higher and moving further away from the 10 year. An inverted bond market is a sign of an unhealthy disbalance, or unbalance, I should say, in the market, where in the near term we see higher interest rates, but in the long term we see negative conditions. Ideally, we'd like to see conditions better as time goes on to the future and rising short-term rates. Not every inverted bond market definitely, guarantees a recession, but every significant recession that we've spoken about has been preceded by an inverted bond market, and that's really why it's so important that we consider these conditions. Again, tomorrow we have PCE, personal consumption expenditure, and another slew of numbers coming next week as well. We hope this has been helpful. We look forward to seeing you back soon.